Hey everyone, this is Connor from 0DTE Traders, and I'm recording this after the market close on Friday. To my YouTube family, I apologize for not posting updates, the market minutes, over the past few days. I've been focused on capitalizing on the recent breakout, managing a trade that went wrong, and live trading with our members. So this video will be short, a quick performance check, what happened this week, and what to expect going forward. I am ending the week green, up $8,260, 14 trades, 12 winners, 2 losers. This was one of my better weeks of the year in terms of P&L. However, in terms of decision making, the quality of the trades I took, probably one of the worst. I made things really difficult for myself this week. And, that's not reflected here in the total P&L. However, I did have my largest losing trade, and that was on Wednesday, and this was a call credit spread, and I kind of got caught in that breakout, and I ended up rolling it to Friday, which resulted in a max loss here, 1,300. Now, we weren't surprised by the breakout. We did highlight in our Wednesday market report that probabilities were increasing for a breakout or breakdown, given how long we traded essentially in that range. Been trading the same levels for 14 sessions. The more times you test a level, the more prone it is to break. So if you are playing that upper bound, lower bound, which is something we played a lot over the past few weeks, to have a plan in place to stop or adjust in case that breakout or breakdown happens, and be willing to capitalize on the momentum those opportunities present. And that's exactly what I did here on Wednesday. We got that breakout. I ended up playing long calls several times here, just continuously rolling those calls up to maintain that leverage. And I ended up making, more profit on that breakout, playing the long there than I did on the max loss. And that's the great thing with options. There's a lot of combinations, adjustments that can be made to turn a losing trade into a winner, to come out net positive one way or the other. And the primary focus is just reducing risk, reducing directional exposure. And there's a number of ways you can do that. What I was doing was delta hedging with a long call, to offset the losses from the call credit spread. But this is by no means the only method. There's a lot of things you can do here, offensive adjustments, defensive adjustments. But I think what is important is that you need to do something. You need to stop, you need to adjust, you need to mitigate that risk, that directional exposure. Now, thankfully, I don't need to do this often. I've rolled the credit spread 3 times this year. More often than not, the trades just work. If your setups are good, your levels are good, there's usually nothing to worry about. But you never know when a trade is going to go wrong, whether you get caught in a breakout, breakdown, a catalyst hits the wire and you get a sharp move against your position or something that you weren't anticipating. Those things are inevitable, right? They're going to happen. If you're a trader, you're involved in markets. So it's always good to have a plan, stop or adjust. And this was really the focus of our Discord this week, managing risk, adjustments, and, turning those losing trades into winners. Finally, we're looking at some charts. This is the SPX on the 15-minute time frame. And prior to the breakout, the range was lower bound, 56.75. This is entry into the 1% FOMC gap. And this presented very good dip buy opportunities over the past few weeks, playing that lower bound. Conversely, the upper bound here at around 56.76, that was the previous all-time high, provided good short opportunities. But the more times you test a level, the more prone it is to break. So we were coming on a 4th test of the high, a 4th test of the low. So it was a pretty good likelihood that we would see a breakout or breakdown this week. And, that ended up being a breakout to the upside, which occurred on Wednesday. And there wasn't a whole lot of momentum on the move. And we'll talk about the reason why upside may be a little bit capped at this juncture, but it did present a good opportunity. This is about 0.5% move, and I most certainly made some good profit on that. But every time you get a breakout, right, you break any sort of level of significance, all-time high, for example, or 5,800 today, you're always looking for it to be validated as support. And those typically present pretty good dip buy opportunities. So if we drop to the 5-minute time frame here, which is generally what we structure trades off of, we're essentially just looking for that back test, nearly back tested it actually on the day of breakout, 5-minute cycle low, that was a dip buy. Several back tests on Thursday, and that was a dip buy. And those played out quite well, and the trend is up. We are above the flip, so when we're above the flip, we tend to favor the dip buys, right? Those tend to be the higher probability setups. But same thing here today. You had a breakout of a level, 5,800, right? It's a whole number. It's significant. You're looking for the back test and that 5-minute cycle low. And those are probably going to be those are going to be your best trades. So as long as we hold above that flip, we remain in the buy the dip regime. That currently sits at 57.45. All strikes above positive, that is supportive for the market price. All strikes below negative, that is destabilizing for the market price. Now the flip can change day to day. So we don't know exactly where it's going to be Monday morning. We'll have to see with the recent data. But unless we get a 1% gap to the downside, it is likely we're going to be opening up above the flip in positive gamma territory. Right now, the gamma index, so dealer gamma, 570 million notional. As far as the upside goes, I think that's the big question. How much upside are we going to see next week? There's a couple things that could limit upside. First off, we got some pretty big resistance levels overhead. Now, we know we're above 5,800, so that's technically going to be support now. But beyond that, we have 5,850, and this is likely going to be the call wall come Monday, so the strike with the highest call gamma, and that is generally regarded as our upper bound. So, anything above that handle we would consider overbought from an options positioning perspective, unless that call wall shifts higher. And essentially what we want to see here for more upside is gamma start to build out of the money, right? 5,900. And this could really happen in two ways. The market comes up to that region, right? Because gamma is the highest for at the money options. Or you start to see calls being added overhead. And you will see this in the open interest change chart. You will see calls starting to build in that region, which is an indication that there's potential for further upside, right? Because that's bullish positioning, and options positioning tends to lead price, hence why we focus on it. So quite a bit of resistance overhead. Also, a dynamic we have to consider here is the upcoming option expiration. This is monthly OPEX on the 18th. It is call weighted, so means there is more calls expiring than puts. So as long as we hold above the flip in positive gamma, that at the money gamma is going to start to increase quite significantly. And right now we can see that big strike is 5,800. So this is potential pin next week, given the market doesn't, have a sharp sell-off and we break below the flip. But what tends to happen is when you near that option expiration, you get a lot of sell flows above, a lot of buy flows below, and it creates that mean reversion pinning effect. Essentially what it does is it kills volatility. Another variable that could cap upside is volatility, specifically the VIX, which remains quite elevated. Interesting dynamic here, SPX making all-time highs with the VIX above the 20 handle. Doesn't happen very often. The reason for this is the VIX measures options from 27 to 34 DTE. I may be off a little bit there, forgive me. But in 30 days' time is the U.S. presidential election. So this is essentially telling us that participants are hesitant to sell volatility 30 days out. And if this persists, upside may be more of a positive drift than a sharp move to the upside. Now, that could easily be negated if volatility crushes, because if volatility crushes, it will invoke buy flows, and you can get a decent move on the upside. Conversely here, if you get a resurgence in volatility, it will invoke sell flows, and it will put downward pressure on the SPX. We're 0DTE traders, so we're not trying to predict where the VIX is going to go next week or 2 weeks out or in 30 days' time. We are just going over what-if scenarios and trying to understand its potential impact on the SPX. And as always, we're just going to trade the market reaction function. We're going to trade our setups and manage the risk, adjust for those trades that go wrong. If you want to join the team and gain access to in-depth analysis, actionable trade ideas, and an extensive options course, don't miss out on our special offer. Unlock your trading potential. by utilizing the coupon code ADJUST at checkout and receive 20% off our quarterly subscription. Go to our website, 0DTEtraders.com, or the link in the description. Limited quantity available. Hope to see you soon.